Good morning, everyone. Welcome to Phillip Securities Research Morning Call for 18th of March 2024. For today, we have quite a few stock counter, technical analysis, and macro updates. So, without further ado, would like to pass on to Darren to get started with Singapore REITs Monthly.
Yeah, thanks, Ambrish. Yeah, so I'll be talking about Singapore REITs Monthly. What happened in February? So basically, the Singapore SGReits index, it fell 5.1% in February, following the 4.4% decline in January, mainly because of the fact that the expectations of any rate cuts have been pushed towards the second half 24. So we are widely expecting the FOMC to hold the federal funds rate unchanged at 5.25 to 5.5 within that band in the upcoming meeting this week. Next slide, please. Yeah, so as usual, we'll run through the statistics or the valuations for the SGReits index. So first of all, this is the dividend yield spread. So what this is the dividend yield, the forward dividend yield of the SGReits index minus the 10-year Singapore government bond yield. So due to the share price correction, or rather the weak share price performance, the yield spread, the forward dividend yield has risen, and as a result, the dividend yield spread has risen from 3.2% to 3.3% month on month. So right now, this is still trading at 1.2%, 1.2 times below the mean, and is basically below the mean of the 10-year dividend yield spread. But that's mainly because of the high 10-year Singapore government bonds, the yield on the 10-year bonds. So this dividend yield spread, we expect it to possibly widen, or rather increase further, basically when the interest rates possibly come down in the second half of this year, and the 10-year yield will start to come down. So that's where the yield spread will start to widen. Next slide, please. Yeah, excuse me. Yeah, so this is the forward dividend yield. Right now it's 6.4% because of the because the weak share price performance in February. So it's risen to 6.4%, and now it's above the 10-year mean. 0.5 standard deviations above the 10-year mean. And looking at the price to NAV, it's at 0.87 times. So it's back to below pre-COVID lows, or rather, sorry, it's back to COVID lows, or even below the lows seen in the COVID period. So right now it's at minus 1.9 times standard deviation. So at this price, together with all the three graphs that I've just shown, we think it's a good time because forward dividend yield is above the 10-year mean, and the index price to NAV is also almost at 2 times below the 10-year mean for the SGReits index. So as a result, we think it's a good time to enter. Yeah, so I'll now move on to our subsector preferences. Yeah, next slide, please. Yeah, so we still remain positive on the hospitality sector. So mainly these are some of the stats over the past month. As you can see, the January RevPAR number, it grew 13%. So this is back to growth after the 2 months of decline in December and November last year. So this is mainly boosted by the Coldplay concert, as you all know. So the RevPAR grew 13%, and hotel occupancy also shot up 3.4 percentage points year on year. So mainly first month of, rather the January period is usually rather low occupancy historically. Yeah, so the average room rates were also up 2.3%. So like I said, it's mainly because of Coldplay. So for the visitor arrivals, it's now the 1.4 million, and this is at the highs since COVID. So it's the post-COVID era highs. And so this is a Feb number. So this February number was boosted by the Ed Sheeran concert as well as the Singapore Air Show. So going forward, we expect the international visitor arrivals to, especially in March, to be higher than pre-COVID levels already. As you see right now in February, the visitor arrivals is 4% below pre-COVID. But in March, we think it will surpass pre-COVID levels already, mainly because of the Taylor Swift concert as we've seen. I'm sure if you went there, you saw that you felt like you were overseas because most of the crowd were tourists and very few Singaporeans in comparison. Yeah, so yeah, basically going forward, we still like hospitality because we think the RevPAR will still remain in this growth trajectory, especially with the solid concert lineup as well as the MICE events. Yeah. One more thing is Chinese tourism. So last year the return of Chinese travelers were very slow. So it's much slower than expected last year. But this year, especially in February, after the 30-day visa-free travel between China and Singapore. So after this was rolled out was on 9th of February, we saw that the Chinese travelers, it grew by ninefold in February. So this is a huge jump from the previous month where it was still very weak, like 30% below. And right now for Chinese travelers, on a year-on-year basis, it's only 4% below pre-COVID levels as well. So yeah, this is really a huge spike in Chinese tourism. Yeah, so this will the return of Chinese tourists will help to benefit retail as well. So moving on to my next slide. Yeah, we're also favorable on the retail subsector. So the retail will these Chinese tourists will likely spend in like town area, like the downtown malls. And we've also seen that the jewelry on a year-on-year it grew 5.5%. So this was mainly probably due to just a solid Chinese returning as well, Chinese travelers returning. So in January we saw that the retail sales index was down 2.1%. So this was a weak, or rather it's down year on year. With the F&B index, we saw it down 5.6%, but this was mainly because restaurants was the laggard. The restaurant segment was down 16%, mainly because the Chinese New Year was being celebrated in February in 2024, while it was in January. So this is why we saw the huge 5.6% decline in the F&B sector as well. But going forward, we think the extra $600 in CDC vouchers, as well as the payment of 200 to 400 to some Singaporeans, or rather to eligible Singaporeans, as well as the $200 in free life SG credits for all national servicemen. This will help to maintain the demand there and resiliency in the Singapore retail space. Yeah. So moving forward to the next slide, please. Yeah, so this is our stock picks or our recommendations. Yeah, so there's no change here other than the fact that Prime US REIT, after the CEO has resigned last Friday, we've changed our rating to under review. And yeah, so we are waiting for more developments for this Prime US REIT yeah, before we consider reinstating our call. Yeah, so that's all for the REIT monthly. I'll now move on to OUE REIT. So OUE REIT was a site visit. We went to visit the Crown Plaza at Changi Airport Terminal 3. So these are some pictures and yeah, next slide please. Yeah, so we visited this OUE Crown Plaza post $22 million AEI. So the picture on the right is the swimming pool. So it's not common for an airport hotel to have a swimming pool. So this is a plus for them. And the RevPAR for this Crown Plaza, it surpassed pre-COVID levels to reach $205. So this is a 24% jump. So the renovation of this AEI included 12 guest rooms, 2 family suites, and all-day dining area. I have some pictures in the following slides, meeting rooms and the MICE space as well. So right now they've also it's more family friendly since they have packages with Kidstopia like in Jewel. So basically during the Taylor Swift and Coldplay concerts as well, there were a lot of day bookings. So what I mean by day bookings is like they come in during the daytime, so they just check in and then they prepare, they put their things down and then they usually leave for the concerts. And after the concerts, they go back to the hotel, then they take a shower and then they leave. So basically they don't spend the whole night there. Maybe just a couple of hours, they leave by 2, 3 a.m. So this was very common, and as a result, helped to boost their RevPAR as well. Yeah, so basically across the board for the industry, the ADRs in Singapore generally increased by 30% as compared to a normal week where there are no events happening. Yeah, so going forward, the demand in first half will be continue to be driven by the mega concerts, as well as the return of Chinese, like I mentioned earlier, and the visa-free policy really helped to bring all the Chinese tourism back to Singapore. And second half demand is usually just seasonally stronger. So yeah, we're not too worried about the second half. Yeah. Next slide, please. Yeah, so the following slides are just some pictures. So that's the gym on the top left-hand corner. Bottom left is the female toilet. They refurbished it, and then now there's a. I mean, I wasn't the one who took the picture. It was Meow Meow's lights. So Meow Meow's the one who took the picture. So she's very happy with that. That they have now refurbished the toilet, and there's this makeup area for them. And then in the center there's a meeting room where you can use it if you pay access to the lounge. The lounge picture is on the next slide, and then the right side is the ballroom. And yep, the next slide, please. Yeah, so this is the deluxe room where you have direct access through the swimming pool, through to the swimming pool. Yeah, and in the next slide we have the most popular room, which is the runway view room. So yeah, you have full view to the runway, and then this will look very nice at night, especially when the lights are on. Yep, and the following slide, yeah, that's the lounge area, and on the right side is the family suites toilet. Yeah, so that's all for me. Yeah, hand over to Zane for technicals. Thanks.
Thanks, Darren. I'll move on to the technicals. Next slide, please. Yeah. So looking at S&P 500, last week we continue to see a consolidation within this short-term uptrend channel in bull. I think we were down. It was largely flat over the week, down about 0.1%. So for this week wise, I think we are likely to see a breakdown of this channel ahead. Given the slowing momentum seen currently in MACD and RSI, as well as the bearish divergence signal, where it formed a lower high while the index was climbing to a higher high. So for now, the resistance is likely to be between 5,150 to about 5,190 area, while the support is likely to be between 4,955 to about 5,055 area. Next slide, please. So for individual counters, first one, we have a technical sell for Palantir at $24.14. Take profit levels at $22.30, as well as $20.30. Stop loss is at $25.50. The stop loss goes at $23.49 on Friday. So looking at the chart for Palantir, firstly, it has broken down this short-term uptrend channel in blue. And this was followed after a false breakout above the $25.50 level, which provides a bearish signal. So if that, given the declining momentum of both MACD and RSI after a bearish divergence signal, we could see the price come down towards these two levels in the chart. Next slide, please. Then the next one is also a technical sell for Broadcom at $1,247. Take profit levels at $1,200 and $1,145. Stop loss is at $1,285, and the stop loss goes at $1,235.50 on Friday. So looking at the chart for Broadcom, firstly, it's broken down this uptrend channel in blue. And then secondly, another bearish sign is that the $1,285, which was a previous horizontal resistance, was unable to continue as support after a slight bounce. So this also gives a bearish signal. So if that, looking at the momentum indicators, which are showing declining momentum, we could see the price come down towards these two levels as well. Next slide. Yeah, so just to summarize these two trades, yeah, so they're both currently in progress. For Palantir, it's up about 2.6% currently, and Broadcom is about 0.9%. Yeah, so that's all from me now. I'll pass on the time to Peggy to talk about Resources Global. Thank you.
Thank you, Zane. Good morning, everyone. We did a not rated note on Resources Global last week. This is to highlight some of the features of the company. Okay, this company is in coal trading and coal shipping, but also broadening, diversifying into shipping of other hard commodities like nickel, sand, and all the other commodities used in production of EVs and etc. They own a fleet of 22 Indonesian flag vessels. It means over here it means 22 pairs, so they have tugs and barges. they also own one bulk carriers that, and all these vessels, they operate transshipment services for the coal mines, meaning taking the coal from the coal mines to the power plants that require these products. And the bulk carriers have been chartered out to third parties for operating offshore on the Indonesian waters. Okay. I can refer you to the table, the chart on the top right hand side. The profit and revenue numbers, the volume has came off and for trading volume, and that led to the decline in the profits for in FY23. The trading volume fell because the mines that they were taking coal from had already reached probably the end of its life and depleted. So from here on, the RGD will need to look for new mines to source their coal for coal trading. Okay, in January this year, they announced the acquisition of Batubara development from the major shareholder. They paid $10 million in the mixture of equity and debt for this 100% stake in Batubara. Batubara owns 31.2% stake in Jakarta listed PT Sini, and through this to PT Sini, this acquisition gives it a indirect 18.7% stake in 4 greenfield coal mines in central Kalimantan. Okay, so we will work through the indirect stake. That means the 2P reserves attributable to Resources Global is about 30 million tons. And these coal are of 4,002 kg, which is widely used in China and India. And also in Indonesia, the PLN used it for their power plant power production. Okay, the production for these 4 mines are expected to begin late 2024. And for this, RGD is going to issue 10 million new shares to fund the acquisition. In its balance sheet, it has a net cash of 24 million, but 30 million has been earmarked to the banks to secure loans for fleet expansion. The company plans to increase its fleet's tonnage by 33% in 2024. What caught our attention was that the net profit has been growing by a 4-year CAGR of 102.8%, though it fell 36% year-on-year in FY23 due to reduced trading volume. And this 4-year CAGR growth has been on the back of very higher shipping income. And they also generate a very attractive ROE of 21.2% with an operating cash flow of 51 cents per share generated in FY23. I show a chart of the coal price index for your overview of the coal sector. So when the price of coal has been on the decline since early 2023, but with this also it has actually stimulated demand for coal to use coal as to generate energy, especially in emerging countries such as Indonesia, China, and India. Okay, next slide, please. Thanks. Okay, so these are some pictorial view so you can understand the company better. Pre-tax profit breakdown: coal shipping of coal has been rising. You look at the blue bar on the left. I use pre-tax profit because they own 50% of the shipping subsidiaries, so they enjoy 50% of this pre-tax profit. Whereas trading has been very small actually. Okay. And on the fleet expansion, they are hoping to raise it to 300,000 deadweight tons by the end of 2024. There's a 33% increase in tonnage, and when they increase tonnage by 33%, the growth in shipping income it will grow faster than that, as they be able to have a faster, higher throughput, as well as the operating leverage from a bigger fleet. Next slide, please. Okay, so this is how shipping margins has been improving for them. It's hit 52.7% in FY23, a very strong set of pre-tax numbers. And as they grow their tonnage, we think there's a chance for these margins to further improve. And in the coal mining side, this table on the right shows the resources, the 2P of the reserves of the coal mines. The total 2P is 161 million tons, and PTCini, which they own 31.2%, has a 60% stake in these coal mines. So that gives effective 18.7% stake to Resources Global and an attributable source of 30 million tons. Okay, that's all for Resources Global. Let me move on to the weekly. Paul is away on a plant trip, so I'll cover this on his behalf. Okay, these are some of the macro data that we saw that came out last week. In Singapore, we had job vacancy numbers for the quarter ended December 23. The vacancy has grown compared to the previous quarter in September, from 78,200 to 79,800. But after falling for 6 consecutive quarters, these vacancies were actually last peak in March 2022. And the ratio of job vacancies to unemployed is 1.74%. That means there's more jobs available in proportion to those looking for a job. And this is this ratio has been rising since March 2021 when it hit 0.96 times. Okay. And these numbers are suggested to us that the labor market still continue to be strong, even though the employment numbers have growth has slowed down. So the strong labor numbers is good for property affordability, probably holding up property prices. And at the same time, especially in the secondary market, and also at the same time, it means that the bank's asset quality for mortgage loans will remain intact. Okay. In the US, we have some data points suggesting that the CPI, core PCE numbers will hold at 2.8% in February, stable from the January number. The headline PPI came in at 0.6%, higher than January's 0.3%, and energy accounted for 24% of the increase. The core PPI is up 0.4%. This is slightly down from January 0.6%. Okay, we have the FOMC and the SEP to be out by Wednesday this week, and that could shed light on how the Fed is thinking about the economy going forward and the interest rates direction. But I think the market has given up hope on the March increase on the interest rates, and looking forward to 3 hikes beginning 3 cuts this year. The first one probably in June. Okay, on the retail sales numbers, also a very weak start to the year. February's retail sales up 0.6%, and for January it was previously reported at 0.8. It's been revised down to negative 1.1% percentage point. So it's indicating a very weak retail sales number, and we see the greater decline in the services sector. Okay, on the mortgage applications for home purchases was up 4.68% the week of March. The prior week was 11%. This is still a very depressed numbers, way down by the high mortgage rates. It currently stays at 6.8% on the mortgage rates. Even although this is down from October 23's high of 7.9%, it's still a relatively high number that cause home buyers to hold back on their purchase decision. Okay, so on the numbers from the US front, it doesn't look too good. In Japan, the Sunto, which is the yearly negotiations for wage increase, was concluded with a very big jump for large corporates, 5.28% compared with 3.8% a year ago. And for the smaller firms, they also have a 4.42% increase compared to 3.45% in the year before. Although only 16% of the Japan workers are unionized, so they are covered by this increase. Still, it points to very strong determination, very strong growth for wages for workers going forward. And this wage growth acceleration could prompt the BOJ to raise their policy rates from the current negative 0.1%. Japan is currently the last country to be still in negative interest rates. And BOJ is meeting this week also to decide on this policy rate. If these rates are not changed in this March meeting, we think it also might likely happen in April. So overall, it's very good for yen-based assets. Thank you. Next slide, please. So tactically, we think this week REITs continue to stay crowded by the rate outlook. And we have also very weak commercial real estate numbers coming out from Germany, looking at some more delinquency. And there are stock-specific risks continue, such as the one highlighted by Darren just now on Prime. So REITs probably will stay weighted down by all these concerns. And last week, we had a round of meetings with some construction companies and building materials makers. The conclusion we walked away was seen the worst in last quarter, fourth quarter 23. Most of them had cleared out their low margins legacy projects last year and are working on better margins this year. And government push for infrastructure development, such as the one announced by Mr. Lawrence Wong at the budget of 5 billion to be spent on energy infrastructure, will favor mostly the civil specialists over the builders. And building material suppliers are one that will ride on the upcycle. The upcycle is not just in Singapore, it also is happening in Malaysia, where there's a lot of building activities out in Malaysia and Penang. As foreign direct investments have been growing, with Malaysia also identified as a second base for company that wants to move out to set up a second base outside China. And so in the major events this week, there's the FOMC meeting and the BOJ happening before Wednesday. And the corporate insights, we have a Tech happening on the 27th of March. Next slide, please. Okay, but I have two Phillip on the ground. Thakral, we hosted a webinar for them last week. Thakral has been always been known for an electronics distributor, but it's transformed itself into a real estate player in the last few years. So the market cap at 5 million Sing dollars. As the real earnings driver now is the real estate in Australia under Gem Life, which they now owns a direct stake in 31.7%. And in Japan, they had a real estate and their key revenue on the top line, key revenue is underpinned by beauty, a lifestyle product distributor for beauty products, as well as tech products. The financials, if I draw your attention to the last line on the table on the left, the net profit fell to 56%. And that's after a 20 million non-cash restructuring cost charge of 20.4 million. So if we add this back to the net profit numbers, it will have grown 47% year on year. Gem Life is the main contributor to the overall group earnings. And basically, what Gem Life does is to build homes for sale in Australia. Most of the this is happening in Queensland, they build the home for sale, they retain the lease for the land, and they charge a weekly site fee income on the land. So the buyers of the home of average of age 63, they are mostly retirees or those looking to downsize to a smaller property of about $600,000 each, average $600,000 each. And so far, GemLife has built 1,400 homes to date, and they target to build 6,500 homes in the next 10 years. And in Japan, they own some 6 assets and commercial buildings, which they collect rental income, and they collect capital gains, and is ready for capital recycling. Another growth driver for them is also the exclusive distribution for DJI products in South Asia. DJI, as we know, has 70% market share in drones in the world. So Thakral now owns the distributorship exclusively for 7 countries in South Asia, and they recently added sector footprint and to cover the enterprise and agriculture products as well. For China, is probably the segment that is seeing a slowdown since early 2024. In China, they are offline retailer distributor for L'Oreal products, and mainly into fragrance. But the management thinks that if they could be able to mitigate the slowdown in the major cities, but with the more outlets added in the other cities, and targeting a wider audience, a wider customer base, addressable market. So for outlook for them is GemLife will be the one that accelerating the growth through more building activities, and they have a 300 wait list of buyers. And they also looking to recycle their Japan assets, and DJI will be penetrating into more sectors that will drive the distribution business. Thank you. Next slide, please. Okay, Seatrium, we attended the Investor Day. The company, during Investor Day, the highlight is really the targets that they set. They lay out the targets for 2028. Okay, the targets are listed on the table on the left. FY28, they hope to achieve revenue of 10 to 12 billion and EBITDA of 1 billion, an ROE of above 8%, and net debt to EBITDA of 2 to 3 times. And by end 2025, they will look to cut costs so that they will achieve a 300 million savings a year in 2026, and procurement savings of 200 million a year 2026. So the revenue growth will be derived mainly from getting more green products in the order book, and a higher share of repair and upgrade business. This is an increase of from 7.3 billion in FY23. It implies a 10% growth annual growth CAGR for the next 5 years. Okay, for the profit growth, they think that by the end of 2024, they will have delivered all their legacy projects which were low margin. So in 2025, they will see improved margins from improved contract terms. How they do this is through shared risk with their customers, and also joint tenders with vendors, equipment vendors, and they also will work on progressive milestone payments on better terms. I think the key driver of to lift the profits will be through the cost cuts that is listed in the table on the left, and the fourth is through asset-based rationalization, closing more shipyards, one in Singapore and one overseas. Okay, our take from the meeting is if you look at 1 billion EBITDA, you take away depreciation and interest costs. So we estimate that flows down to about 300, optimistically, 300 million net profit. So if we use the current market cap of 6.1B and enterprise value of 6.9B, that works out to about 20 times PE, 6.9 times EV/EBITDA, that stretch out into FY28. So is the market seems to have been fully priced in this expectation. And another thing to note is on the net debt to EBITDA, it was 3.2 times in FY23, but the net debt was as at end December 23 was about 750 million Sing dollars. So to achieve a net debt to EBITDA of say 3 times on the EBITDA of 1 billion, which means they will raise their net debt by 4 times, increase the net debt by 4 times to 3 billion. So there's a huge jump. So the thought behind the next thought will be, unless the order book can jump at the same level, by 4 times as well, the increasing net debt at the same quantum looks a bit it might weigh down on the in terms of interest costs. And the net order book that they had at the end of FY23 was 16 billion. Just a rough for discussion. Yeah, that's all for me for Seatrium. We don't have a view on it. These are just some of our just preliminary thoughts. We can maybe move on to the Q&A. Thank you.
Let me take over for the Q&A, folks. Quick one. Your REITs money never include City Development Hospitality Trust. Any reasons? Can you comment on its impact on City Dev or outlook in the next one? Yeah. So we didn't include because basically we don't cover CDL Hospitality Trust. Yeah, but we do cover the parent City Dev. So are you able to comment on its impact on City Dev or outlook? Yeah. So basically the improvement in hospitality and the recovery in their numbers will benefit the parent City Dev because they own a stake in them. Yeah. So yeah, I'll perhaps leave the question here for Zane to do some technicals on that. Yeah, but we do not cover CDL Hospitality Trust. Any thoughts on CICT and Paragon REIT? Yeah, so CICT and Paragon REIT, first of all, their retail space like the downtown mall, especially, yeah, that one will benefit especially since the return of Chinese tourism, like I shown in the slides just now. Yeah, it's 9-fold in February year on year. Yeah, so 9 times, and this is just only lagging pre-COVID levels by about 4%. So the return of Chinese travelers are basically back already, and this will help to benefit the downtown malls at Paragon. So the international visitor arrivals will really jump up, and the Chinese historically they used to be big spenders in this downtown mall, so that will help with the tenant sales, and as a result will the negotiations for higher rental reversions will be better for these two REITs. Yeah, so that's basically the retail side. So Paragon REIT will probably benefit from that, and CICT, the downtown mall side as well. And for the office side for CICT, it looks relatively stable. Occupancy remains stable as well. But we do note that reversions for office might be a little bit muted with the incoming supply of IOI Central Boulevard and Keppel South Central. Yeah, so I'll leave these two for Zane to do technicals as well. Any comments on Mapletree Logistics and Mapletree Industrial? Yeah, so for Mapletree, these two weeks we also do not cover. I'll leave it for Zay to do technicals, but we see some comments from me is that for Mapletree Logistics, the China side is still struggling because especially from the e-commerce expansion back in the COVID era. So a lot of these e-commerce players, they expanded way too much, and now they are contracting, or rather the space they required are much lesser, and they're consolidating as well the space requirements. So there's a little bit of headwinds there for MRT, and for MIT there is a little bit of weakness from the US data center side, as we've seen the occupancy for the US data centers dip to 89%. Yeah. So those are my just quick comments. Yeah, sorry, not so in depth because we do not really cover these two counters. Yeah, then you mentioned that it's a good time to enter it based on data present. Can you share what are the top 5 counters that we invest in? Yeah, so for this we have the table there. So sorry if Ambrish, could you circle back to that recommendation slide? Yeah. So those are some of the picks that we have. Yeah, thanks so much, Ambrish. Yeah, this one. So yeah, these are some of the recommendations that we have. Yeah, and some of it are overseas and some of it are local. So for I would say the lower risk players, I would say like CapitaLand, Escort Trust, Vice Hospitality Trust. These are the lower risk with their assets. For CLAS, more geographically diversified, and Vice Hospitality Trust is very centered in Singapore, but Singapore's hospitality assets, like I mentioned, because of the strong RevPAR growth and international visitor arrivals coming to Singapore as well, especially with the added boost from China. So these two will be fairly safer place and more resilient. And then for more risk takers, you can look at some of the REITs with overseas assets, and one of it is that perhaps Elite Commercial. They are paying like look at this forward DPU yield of about 16.2%. So these are the higher risk players. Yeah, and Cecil REIT as well. Yeah, so these are our topics. Yeah, thanks. Yeah, thanks, Ambrish. Okay, I'll move on. Please is a preference CDL, UL, and CapitaLand investments fundamentally. Yeah, so we prefer CapitaLand investments. So that's our topic mainly because of it's more of a fund management company rather than a property developer, because they've already, as you all know, they've already privatized their development arm. Yeah, so we like it because of their recurring fee income structure. They have a lot of fees from all these kind of safer sources like the listed REITs and the private REITs and the private funds rather, as well as the fees from the lodging business. So this fee income structure will help to is recurring in nature, and there's some visibility to it. So we prefer capital investment for that reason, and then will be followed by CDL and UL. So right now, as we all know, the development pipeline in Singapore is that there's some headwinds there because of basically higher construction costs, and as mainly the higher ABSD is affecting foreign demand. So we've seen the sell-through rates also not too good as compared to 2022, where before the hike in ABSD. So their CDL, their development segment will be affected. Yeah, so our topic there is CLI. Okay, I think I'll hand over to the rest of my colleagues. I'll circle back again later. Thanks.
Okay, thanks. Darren, I'll take some of the questions. Okay. Peggy, your thoughts on Samudara shipping outlook in next 12 months. Thank you. Okay, I a bit cautious on the Samudara. Okay, they have a net cash of 73 cents, so I think the per share, so I think the price is supported at this level. But on the outlook wise, we look at their nearest comparable, SCL listed in Thailand. SCL is still guiding for lower freight rates coming through for the regional feeder services in this region, in Asian waters. And so container rates are still coming down. And in Singapore, we are going to implement it's under BEPS, which means that the shipping companies will likely have to be paying a minimum tax compared to right now they are shipping income are really tax free. So just roughly, if you take second half numbers of pre-tax of 38 million, and multiply by 276. So so which means that you have to set aside maybe 11 million tax to be paid going forward. So therefore, just with this higher tax bill alone, you expect the earnings to fall. So therefore, we're very careful on the shipping sector right now. Especially when still not clear how the tax is going to be imposed. In the latest budget, it was said that the tax will be charged on the net tonnage, but we're not sure what sort of net tonnage and how the tax man wants to calculate the next net tonnage. So therefore, we'll until that is clear, we remain very, very cautious. Okay. Hi, Peggy. Can you compare Resources Global Development with Joe Energy, which is involved in coal mining as well? Thanks. Yeah, when I wrote that report, I was trying to do a comparison, but I find that it's very difficult to it's not really a direct comparable because if you know Joe is involved in coal mining, but Joe yearly have to apply for a production quota. So the production output is not something within their control, right? They have to apply for it and get it. And the last time they wanted to increase it, they couldn't get it. So which is probably the reason why Joe decided to move into buying the Jakarta listed PT Gem to expand its space its resources. So in this sense, Resources Global is really a very indirect stake, and it will only be associate accounting for it, and it will be the work will be outsourced. We think we will not ascribe a very big value to the coal mines compared to Joe Energy's. So because they don't really exactly operate it on its own, and so we find very difficult to they're not really apple for apple comparison. But if you want me to do a study into Joe Energy specifically, maybe I'll do that and come up with a view next week for this webinar. Thanks. Hi, Peggy. US petition against China's shipbuilding subsidies and calling for support for US shipbuilding sector. What's the impact to Yang Zhejiang in your view? Thanks. Okay. First thing first is Yang Zhejiang does not have any US customers. Okay. Some of the so-called US customers actually like C-SPAN. There's actually a Canadian-based customer or European customer. North America totally they don't have contract with any North American customers. So that fund doesn't hurt their current orders, and really US shipbuilding sector is really is never been in our radar at all. After so many years of covering this marine sector, they've never been able to, they've never done any work that is being sold outside the US. Most of the work they do is for their is for use in their home country, and of course they had a lot of work coming out from the military, from their own national defense sector. So we think this is really is too far to, it's really too remote to have an impact on the China shipbuilding sector. And in fact, right now across the entire China shipbuilding sector, everybody is full. All the yards are full with orders, as the China themselves are also ramping up their own fleet to supply, to do shipping on their own. You just look at BYD, they decided to build their own Ro-Ro to ship their own cars to Europe, because so that they don't get to be by the shipping lines. So the China shipyards are really very, very full. I think this is more I think the impact is really very small. Peggy, POJ likely to reverse its negative interest rate policy. How does this impact SG market? We think maybe it will help to re-rate those REITs with Japan assets, such as Daiwa House, Logistic, or even First REIT with nursing homes in Japan. Of course, at the same time, we might also increase the interest cost that is paid in the interest cost on the borrowings that are borrowed in yen. But overall, we think it will give an uplift to the asset value for those yen-based assets. Thank you. Seatrium proposed 20:1 share consolidation. Can you share what this means and how it will influence in whether to buy or to sell? Okay, a very lame answer to this is it will raise the share price. But whether it will means current share price times 20 is a big question here. Sorry that I think the focus should probably not be on the share consolidation so much now. I think the market is looking to see how they can secure new orders going forward. It's like what they want to what they say they want to secure more new green products. I think the share consolidation will probably not have any much impact on whether to on the action to be taken. Yeah, thanks. Okay, and also another question on Seatrium, so maybe I covered that too. Peggy, your call on buy sell hold for Seatrium. The presentation at the Investors Day appeared to do more harm than otherwise. Your comments, please. Thanks. It's not fair for me to give a view on Seatrium because I don't have a earnings forecast for them. And why I don't have an earnings forecast for them is because I feel I really don't feel confident enough to put a number, because we're not sure what sort of asset-based rationalization they will take going forward. The information provided was quite vague, except that there will be a yard that is going to be closed in Singapore and another overseas yard, which we don't know which one. And how much cost they will reduce, how much redundancy they might have to incur. Also, on that front, also how much more work they need from going forward. They need to outsource to third parties, and that will mean that they will have to share the margins. Okay, so for that, I'm not confident enough to come up with a number. But suffice to say, as we walk away from Investor Day, we don't find any catalyst for re-rating for Seatrium. unless we can, I think the best catalyst that we can look forward to will be if they can announce some new order wins. Thank you. Uni Asia attended last week webinar. Your views on its outlook. Seems its business seems focused on shipping and property. However, it does not any specific directions on these two sectors. We dropped coverage on the stock. We mainly because again the charter rates are on the way. Are not going to look up. We up for next 2 quarters at least. We believe because overall the shipping rates are still on the decline. So that's for the shipping side. On the property front, the Japan property seems to be doing okay, but Hong Kong will be a drag, and we are really not sure how that will turn out. Given that these are co-investments with many investors are also in the game, and so we feel that we couldn't see any positive coming out for the company in the next 2 quarters, and therefore we decided that we will not have cover it for the meantime. Yeah. Thanks. Okay, next question. So in your view, is Seatrium will sell? I would sit and wait it out. Yeah. I hope that's the best answer. Thanks. How is housing sales and the performance of PropNex going forward? We think the launches are going to increase. New property launches going to increase from March onwards. In fact, it's happening. So the total unit transaction volume will be higher than last year, which was already a very low level. So for new launches, they typically get a better margins. For PropNex, we think that they'll do well. And as new launches come out, there'll be it will stimulate more activities in the after sale, in the secondary market. So the velocity will go up for property transactions. So we think overall it benefit the property agents. The only sector that might look a bit weaker will be the rental market. Is more properties are more buyers are able to take to collect their keys and move into houses, the homes. They will give up their lease rental. So we still think that the property agents could see a better numbers coming in FY 2024. The only thing that could hold back, if at all, will be affordability. So that Singapore, the income level of the population, the jobs data this data we should watch. If otherwise, the underlying supply and demand looks intact. Thank you. What is your buy price on Sembcorp and Keppel Corp? Okay, we have a target price. Sembcorp is $6. Keppel is oh shit. Let's take my mind. I'm so sorry about that. Yeah. Less than $8 at least. Yeah. But our target price, what it means by target price is our 12 months target price means that we think within the next 12 months it will hit this level. So depending on how much profit you hope to, how much returns you like to achieve, then you can determine on your own buying price for these two companies. Thanks. Can I pass on to maybe Glenn first, while I sort out the rest? Thanks.
Yep, sure. Yeah, let me take over first. I think there are like maybe 1 or 2 questions on the banks. First one is, okay, I think about Singapore. Yeah, any insights around the 3 banks, DBS, OCBC, and UOB, and also Singapore interest rate outlook and impact? Yep, so for the Singapore banks, I think they're all quite similar. So we're looking at, I'll just go through roughly their segments, right? So their main segments. So, I mean, the first main segment would be their net interest income. Net interest income is looking to be flat, or even it might even dip slightly going into this year. And this will likely be due to the sort of the flattening of the interest rates in Singapore, and their funding costs, which have actually creeped up quite a bit. So their loan yields, which is how much they earn from giving out loans, have actually stagnated. But their funding costs, because interest rates are so high and they have to be quite competitive in keeping their deposits, has actually creeped up quite a bit. So this is what we have seen in the last quarter, where their net interest margins have actually dipped slightly. But I think the banks, what they have said is that how are they going to maintain their net interest income? They're going to do it by sort of lowering their funding costs. So they're not going to be as aggressive or as competitive to retain loans, deposits, because they have a bit too much deposits now. Yeah, so that's what they have been saying, and they don't mind losing some of this not so sticky deposits. So they will maybe be not as aggressive. I think they're competing not maybe amongst themselves, but with the foreign banks which are in Singapore. So looking at all the like the Citibank, HSBC, even some of the smaller regional, the ASEAN or Asian banks which are in Singapore, the Chinese banks. So they are giving very high interest rates, which is why the local banks have to compete by giving equally high interest rates to attract customers and their deposits. But now they realize that it might not be such a viable option for them, so they are going to cut back on that, which will lower their funding costs. And I think so the other factor which we could see maybe having an increase where they will sort of be able to boost back up their net interest income would be this sort of refresh of their interest earning assets. So they're gonna, some of them, I mean, most of them don't really state how much is it, but they are going to sort of put in this their interest earning assets into new longer tenures and higher interest rates. So they're going to lock it in at the current interest rates, those that have sort of reaching their end of the tenure. So that's how they're going to try to capture this sort of this tail end of the high interest rate environment. Yeah. So okay, now moving to the next segment. So we have seen net interest income will be flat or even dip slightly. So what will be the growth driver for the banks? I think firstly it would be their fee income. So they're looking at fee income to be improving quite a bit. And I think mainly it'll be coming from their credit card fees, which all the 3 banks have shown a sort of significant improvement, especially with UOB. UOB is the only one that has been sort of stating very clearly the reasons why. And it's because of their collaborations with all the acts that are coming in Singapore, like Coldplay, Taylor Swift, Bruno Mars, Ed Sheeran. Yeah, so that's what has boosted their credit card fees, right? But I think the main step for them, at least for UOB, is not about the initial boost, but it's how to maintain that customer and maybe to push them towards other sources of revenue, like their wealth management, or maybe even to the CASA, the current account, savings account, to open an account with them. Yeah, so that's what they are concentrating on. And another factor you look at for fee income would be the acquisitions, which are now all 3 banks have done. So the Citibank assets, which have been UOB and DBS, and also now OCBC has come in and also done an acquisition for that smaller bank in Indonesia, the PT Bank Commonwealth. So these acquisitions will help them to grow sort of inorganically, because I think organically it's slightly muted, so they're trying to look to grow outside into the region. And this has added quite a significant amount into their fee income, and also to their loans book portfolio as well. So another sort of part in their fee income which we could see positive growth and which will probably boost their earnings, which would be their wealth management income. So wealth management income, we have been seeing that their AUM, or assets under management, the wealth management assets under management, has been steadily growing despite the recent, despite even last year we have seen it growing. So it hasn't dipped, but wealth management fee income has actually dipped, and this is because due to the market, and it's not doing as well. So they are not earning as much. So DBS has said that currently I think they're only earning 100 basis points from their total AUM, which is, I guess, it's quite low. So I mean, they weren't very explicit in saying how much more they could earn if the market does recover, but they did say that yes, if the interest rates go down, there would be an upside to this 100 basis points, and I think it's the same for the other two banks as well. Yeah. So looking at all this, okay. So the last one, I guess, would be their expenses and also their provisions. So okay, touch on provisions wise first. Their provisioning or their allowances has been quite stable, and I don't think they they are looking at their loan book quite stringently and also doing a lot of stress tests, and they said that the provisions will probably be quite stable. And I think, if I'm not wrong, it's around below 25 to 30 basis points. So this is sort of going back to the pre-COVID levels where at these levels, it might even be better than some of the banks might be better than pre-COVID levels. So we won't see like single-digit credit cost basis points like we saw, because that was mainly due to a lot of write back of their general provisions. But we will see sort of this stabilizing allowances going into 2024, and this will sort of like make it quite flat, I would say. And lastly, their OPEX, or their operating expenses. Operating expenses wise, I think they would be trying to control it. They won't be they already said they won't be as aggressive to try to capture new talent or try to increase salaries as much. But I think they will still, of course, be putting it to the market rate, and I think the technology side, they cannot stop really trying to put in more funding for the technology side. But they said that their CIR, or cost to income ratio, will be flat going into this year. So looking at all that, I think the banks are poised to do quite well this year, despite the expected cuts in the interest rates, which will definitely affect their net interest income. Yes. Oh yeah, and loans growth. Sorry, loans growth also is another important segment for the banks. They are looking, at loans growth being flat or even dipping in the first two halves of this year. So first half, second half. But when the interest rates start to go down, which is expected in the second half onwards, we could see a pick back up, and this will overall, I think we're looking at a low single-digit loans growth for FY24. Yeah, so for the interest rate outlook, I think Singapore interest rates, we have seen the last few months of data, at least in the first 2 months of 2024, and we have seen that it's gone down by like 5 basis points and another 5 basis points in February. So total of 10 basis points. We could see this continuing and maybe flattening, low single-digit kind of basis points reduction month on month continuously. But I guess it will just be quite flat. Interest rates will definitely not go up in our expectations. And if it goes down further in the second half, then I guess it will be beneficial for the bank's loans growth at least, and also their wealth management fee income. Hope that answered that question enough. Let me move on to the next one. US banks like JPM continue to grow in 2024. Is Citi growing? So let me go to Citi first. Citi, we don't really cover the US banks, but I'll just briefly touch on this. Citibank is still growing, I would say, but their recent cost-cutting measures have cost them quite a bit, right? So that's the reason why maybe their earnings aren't performing as well as it should be. But I guess it's more of a long-term play. At least that's what the CEO has said, where they are looking to maybe initially it'll be quite painful because you have to pay off all these sort of employees that they are cutting off. Yeah. So it'll be quite painful in maybe the first year, at least in 2024. But if you move forward, I think the growth will be similar to the other banks as well. So banks like JPM, Bank of America, Wells Fargo, they face a similar situation to the Singapore banks, whereby their net interest income will most likely look to dip and to suffer a bit from the expected lower interest rates. And also their funding cost is, I think, for them it's a lot more I would say it's more severe. You know, it's more if you look at their funding cost for the US banks, it's a lot higher because there are so many banks there and they really have to fight for their funding and their deposits. But if you're looking at like JPM, you mean the big three or four, five banks, right? They may not need to do as much as the regional banks. So the headline news now is that the regional banks are really suffering because they have to fight for deposits, all the smaller banks. And that's what is making their funding costs go up. But the bigger banks, I guess, are more stable. So they are unlikely, no, they're not unlikely, but they are not as affected as the smaller banks in terms of funding costs increasing. And also they're looking at their fee income going up as well, mostly from their wealth management and also investment banking side. So yeah, they are still, to answer your question, yes, I do expect them to continue growing into this year. I think that's all for me. Maybe Peggy, if you want to take it back.
Yeah. Okay, sure. Thanks, Glenn. Thank you. Okay. Let me try. These are tougher ones. Okay. Okay. Peggy and team appreciate comments on recent Singtel saga and its outlook. Okay. I trying to recall what Paul has written and his views. We think it's not okay. It's a lot of distraction, but it doesn't. Singtel's longer term focus will be to do like a capital to asset monetization, and in their books they have many assets that they can do it. Mainly the data centers in the portfolio, and they have a lot of properties sitting around. Like if you drive out to any road, at the corner you see a Singtel exchange somewhere. Okay, so it will be able to lighten their balance sheet and with that realize a lot of values back into and maybe reward shareholders again. So I think because of this focus, we favor Singtel as a revaluation story. Of course, the recent issues with Optus and so on might have created a lot of distractions, but we think the longer growth story for Singtel on the asset monetization should still be intact. Thank you. There's a question for John. He sent me his answer, so I will answer on his behalf. Hi, Jonathan. What can we expect from NVIDIA's GTC event this week? Thanks.
Hi, Peggy.
Okay.
Sorry, actually, I just joined.
Okay, John,
can take
can you take?
Yeah,
okay.
I can take it. Hi. Uh, sorry, I was in another meeting. Yeah, so the question here is, hi, Jonathan, what can we expect from NVIDIA's GTC event this week? So essentially, what we think they're going to be talking about is their B100 AI GPU chip, which essentially is an upgrade over their H200, which they launched towards the end of last year. When they launched it, it didn't really give much details on it, so I think they'll probably explain a little bit more on that. Secondly, we think that they could start giving us also more color on the sovereign AI efforts that they are seeing from sovereign nations, and whether this could lead to more sustained demand. Because over the last couple of earnings call, they've just briefly mentioned it, never really give us much color on what nations are doing it and what's the scope of it. So it'll be interesting to see if they do give us more info on that. And then the third thing will obviously be related to AI. What kind of AI initiatives they're planning to kind of do for this year, and who are they partnering up with? Because most likely they're going to be partnering up with a lot of the other big tech companies, like Microsoft, Google, etc. So those are the three main things that you probably start to see or something that we should expect to see in the GTC event this week. Yeah, hope that helps to answer your questions. Thanks. Oh,
Okay,
sorry. Sorry, Darren. There's
go ahead.
another question. If I want to stay in semicons, should one sell NVIDIA and pivot to AMD for future growth? So that it's quite tough to differentiate or to sell NVIDIA and then move into AMD, especially if you want to in AI. But if you want to stay in semicon, there could be reasons for it, because for NVIDIA, most of their revenue comes from AI GPUs, right? So that's your AI servers. Whereas for AMD, it's quite evenly split between your AI GPUs, your AI servers, your traditional servers, your consumer PC products, gaming, etc. And so the argument could be had that given AI has run so fast in the last year or so, whilst a lot of the other segments have really kind of bottomed out, it could make sense based on valuations if you pivot to a company like AMD. If you still want to be in semiconductors, but you want to reduce your exposure to I guess the AI play, if you see a recovery, although we do think that a lot of the pricing and a lot of valuations for AMD is actually is quite heavily favoring a large mix of AI. So if you do want to pivot to other semiconductors, probably not AMD, you probably would want to look at other companies that aren't extremely high valued, which is far and few in the semicon space right now. Because a lot of the AI plays being baked into a lot of these companies. Yeah. So if you my theory for this year is that if you still want to remain in semicons, there's no harm to keeping NVIDIA if you do have it, rather than sell NVIDIA and buy AMD. It's probably less upside to AMD. Yeah. Sorry, I know it may be a bit confusing, but I hope that helps. Thank you. Yeah, over to you, Darren. Thanks.
Yeah, thanks, John. Okay, let me put that up. Sorry, my questions. Oh, okay, found it. Hi, there any opinions on why the recent pullback in price of AMC, Perry, and Paragon REIT? Yeah, so I don't see any specific company reasons, but I'll just say it's more of the macro theme where, like I spoke earlier, the expectations of any rate cuts have been pushed forward, or rather pushed to the later half of this year. And yeah, the market widely expects no rate cuts this week. So as a result, the REITs all had faced a bit of sell down. So yeah, it's basically in line with the rest of the market. Like in February, you saw the REITs all the REIT index came down by 5%. Yeah, so it's more of a macro thing, I would say. Okay. Are you aware of any latest update on OUE REIT? Yeah, so OUE REIT, basically they halted their dividends, and because of the portfolio valuations and the weaker performance in China, I think the portfolio value declined by 40 over percent. So as a result, their gearing has already is now at 58%. Is above the limits, but then the thing is they are already not paying distributions. So yeah, so that's the latest for that. Yeah. What's Bank of Japan's imminent rate hike means to SGReits? Yeah, so I think Peggy mentioned a little bit about it earlier already. It will affect the SGReits with Japan exposure, like Daiwa House. So if the Bank of Japan does increase the rate, then it would affect some of these REITs with Japanese loans, as they will incur higher interest as well. Because now, like for example, Daiwa House, their loans, or rather their interest that they're paying is under 1% still. That's in comparison with a lot of other REITs where they're paying, you see 3, 4, 5, or even 6% interest cost already. Yeah, so if they do raise the rates, I guess it will impact them. But the thing is, with some of these REITs, especially with Japanese loans, a lot of these Japanese loans are fixed, so the impact might come later and not immediate. It will only come after the hedges fall off. Yeah. Is Daiwa House a good buy now as dividend yield is for 8%? Yeah, so basically Daiwa House you do not cover, so I can't really comment on that. But yeah, their interest rate is fixed, 100% fixed at under 1%, so they will not be immediately affected by the increase in interest rate, like I mentioned. And yeah, it's more like a stable play where you just get 8% yield. Personally, I mean, like a lot of the other REITs, I do not see much share price appreciation potential, but it's more of a safe play where you sit back and happily collect your 8% or 9% dividend yield. There's a more conservative play. Please kindly explain the financial governance ratio that got Manulife in trouble. Which ratio should we look at? Please kindly list the percentage of each ratio shouldn't exceed. Any other overseas REITs that are quite close to breaching these above ratios? Yeah, so there are a lot of parts to this. So I'll go bit by bit. So first of all, the financial governance ratio that got Manulife in trouble was the unencumbered ratio. So this was not the MAS limits, it was basically the bank covenants. So they had in their bank covenants, they had a 60% limit. So what this means is basically the unencumbered gearing, it refers to the ratio of the unencumbered consolidated total debt, and this is divided by the total consolidated unencumbered assets. So this ratio, it cannot exceed 60%. But in Manulife's case, back then it exceeded by a little bit. I think it was 60, like just by a few basis points. So that was still a breach. Even if you exceed by 1 basis point, you still consider a breach. So yeah, as a result, they breached and they went through their whole recapitalization plan. So that is the unencumbered gearing ratio, which is the bank covenants. And the other ratios you should look at is perhaps the MAS aggregate leverage ratio. So this is the one that you are all familiar with, the 45% gearing if your interest coverage ratio is below 2.5%, or 50% which is 50% aggregate leverage limit if your interest coverage ratio is above 2.5%. Yeah, so that is the MAS leverage limits, and basically the one that Manulife breached was the bank covenants, the financial covenants, which was the unencumbered ratio that I explained earlier. Yeah, so this for REIT to be in safe territory, basically they cannot breach both these bank covenants as well as the MAS leverage limits. And are there any other overseas REITs that are quite close to breaching these above ratios? Yeah, so there are quite a number that are trading above 45. Yeah, I'll pull out a prime US REIT, for example. Yeah, so prime, they are now at 48%. So, but their interest coverage ratio is still held at about 3.3. So they're still within the MAS leverage limits. But they have this upcoming refinancing as well that they need to do. And as a result, we have moved our recommendation to under review, or changed our recommendation to under review, and especially since the CEO has left us. So we need to know like the direction that the new management will take. Yeah, so which is why we've moved it to under review. So yeah, that's just one of the overseas REITs that quite close to breaching the above ratios. And yeah, a lot of these are perhaps the office REITs overseas as well, like the US office and like Keppel Pacific Oak as well. they took a more proactive measure where they halted distributions to ensure they do not breach any financial covenants and MAS leverage, the gearing limit. So this is more like a short-term pain for the longer-term stability and safety of the REIT. Yeah, but the US office still, a lot of headwinds there, and the worry is the refinancing as the liquidity and a lot of banks that are no longer lending. Yeah, especially since interest rates now have been the cuts have been pushed back further. So as a result, a lot of these REITs who back then took floating loans to buy these assets, now they are experiencing a negative carry. So basically the rental that they earn cannot cover the amount of interest that they pay. So which is why you see a lot of these commercial properties in the US defaulted and taken over by the banks. Yep. CityDev results were dragged partly by interest expenses. Please kindly list gearing of CityDev, UL, and HOBI. Yeah, so I have the numbers up. So CityDev, the net gearing is 61%, UL is 24%, and HOBI land is 80%. Yep, I think that's all for me. And anyone wants to take? If not, I'll hand over to Zane for the TA section. Yeah, I think I'll hand it to Zane.
Let me just answer
thanks.
the capital question. Yeah, there's a question on capital. What is the please kindly indicate the profit contribution in percentage of the segments for Keppel Corp. Thanks. Okay, sorry, I slipped my mind just now. Keppel's target price, our Keppel target price is $7.98. On this a split in terms of earnings contribution, energy and environment will still in our FY24 forecast, energy and environment will still account for about 79% of the net profit. This is of course to mainly power generation and sale, and urban development, which is the developing properties and for sale, that will account for 39% of the profit. Connectivity, which is mainly M1 and all the data centers, is about 13% of profit. And then corporate and others, which is mainly corporate expenses, that will take away 31% of the profit. So resulting in our net forecast of 950 million for the FY24 numbers. Thank you.
Maybe I'll let me take one last one, Peggy.
Thanks.
Yeah, okay. Before I hand it over to Zane for the TA, what's target price for IFAS and is growth achievable? Yeah, sorry, we don't cover IFAS, so no target price. But your second part, maybe I can answer. I think there's a lot of questions now. I think even the last week or so we had a question why IFAS share price dropped so much. Okay, I think for IFAS mainly it might be because of the people who are taking profit, right? So they saw the stock price shoot up to very high levels right after their quite good FY23 and fourth quarter earning results. But then resultantly the share price shoot up really high and everyone I think maybe started to take profit, and they sold it, and now it's like hovering back where it was like maybe 6 months ago, right, at that price levels. Yeah, so for IFAS, I think growth is achievable because if you look at what is sort of making their earnings grow, it would be their Hong Kong e-pension business, which they have given clearer guidelines now, and this will give them quite a good boost to their earnings. And also their core business is also improving, so we have seen their AUM go up despite all this volatility and the market isn't doing as well, but their AUM also has gone up. And furthermore, their core business also has shown improvement. And I think the two things that will make them grow would be, of course, make them grow further would be their Hong Kong e-pension business, which they can get revenue for another 2 to 3 years. And the second one would be, which is what they're calling the global bank, iFast Global Bank. So they did acquire this UK bank, and while it's still loss-making, but they are expecting it to sort of reverse this loss by 2025. So 2024, the losses will be a lot smaller, but going into 2025, I think we will start to see that this segment of their business, the banking segment, will show positive returns and earnings. So, they have something in place even after the e-pension, if or when the e-pension business, that profits drop off. So they do have like sort of a plan going forward, which will sustain them moving into the future. Yes, hopefully that answered your question. I think that's all for the fundamental side. I will hand it over to Zane for the TA. Thanks, Zane.
Okay, thanks, Glenn. I'll move on to the TA portion. Yep, so first up is Marvel. So for Marvel, I think currently the share price has pulled back quite a bit, breaking below the 72 level. Currently is retesting back the previous resistance back last year between 63 to 66. So I think short-term wise, we could see a bit of a bounce, but I think it will be quite weak because we broken this uptrend support line as well. So I expect some resistance to come in around $70 before you could see some sideways consolidation ahead. Okay, let me see the next question. It's on SoFi. So for SoFi, I think some weakness recently. With the breakdown of this support line over here, price hovering around the 720 about there. Yeah, so for short term wise, I think we could see a bit of bounce, but expect resistance to come in quite fast around 740 over here. Then we could see a continuation of the trend of lower highs and lower lows for the time being. Then as for C3AI, C3AI also showing some weakness. So after the earnings gap out over here, it couldn't sustain the 33.70 this level. And then we are starting to see the price drop down. Also, secondly, also couldn't sustain the $30.20 level over here. So I think we could see the share price drop a little bit lower towards maybe 27.30 over here to retest another prior horizontal level before we see a bit of down. Yeah, then okay, next one. Your assessment on NXT, please. Okay, NXT is next tracker. So for this, I think long term wise is an uptrend, but short term wise currently is just consolidating in the range. There's likely to be some resistance ahead from this key trend line over here that bring resistance around 60, close to 64. And also for now the range resistance is around 61.70 about there as well. Yeah, so I think for near term wise some consolidation ahead, but going forward there's also likely to be some key resistance ahead for this counter. Okay, then next one is on Fraser's Centerpoint Trust. And so for this counter, I think nothing too much. Is basically just range trading. You can see the price retest some lower support levels like 213 to about 215 over here before we see some bounce again to continue with consolidation. Okay, then next one is Suntec REIT. Okay, Suntec REIT did a retest of the low over here around $1.05. Started to do a bit of range bound over here as the price continue to find support around that level. So I think for the time being, we could see a bit of a sideways going ahead first for this counter. Okay, then next one is Mapletree Logistics Trust. Okay, for this, the downtrend I think is still quite strong. Still seeing a breakdown of 145 around there. So you see the price continue drop a bit lower towards like 140, 141 to retest a swing low in October last year before you find some a bit of a bounce to do a bit of range trading. Okay, then for Mapletree Industrial also showing some weakness. Currently I think it's just is trading is within this descending wedge over here. So we could still see some weakness ahead towards 223 about there. Yeah, as a near-term support. Then it's for this counter. Next one for Wilmar. Wilmar to be honest, currently just range trading, but I think near-term wise could have a bit of upside. If can break out of this 343 level, we could see price go towards like 349 or 355 about there to retest a downtrend resistance line. Yeah. For Capital DC REIT, I think still some weakness. Since breakdown of 172 just become range consolidation, lower highs. I think we could see a retest of 162, 163 over here again. The recent swing low in February. Okay, then for Singtel, Singtel I think is looking better. Recently breaking above this blue color downtrend channel over here, as well as we are seeing price break above downtrend resistance line over here, retesting a swing high at around 248. So I think as long as price can hold sideways over here, then it could still further upside towards 254 in the near term. And so that's for Singtel. Okay, Seatrium. Seatrium, I think today there's some renewed weakness. Couldn't sustain. It couldn't form a higher high over here at 0.096, and the price was compressing with higher lows, but then today was a breakdown over here. So I think with that, we are in the near term, we are likely to see price continue to form lower lows with next support levels around 0.081 as well as 0.078. Okay, then for Apple Corp, I think it's still just a bit of a range trading, still holding at this key uptrend support line over here. So I think, yeah, could see a bit of a bounce between 720 or 730 small range for the time being. Okay, for Ascendus Trust, Ascendus still trading in this downtrend channel over here in retest of the 265 level. We could see a small bounce, but I think near-term wise, it's still some quite strong resistance around 260 and 270. We could see a bit of bounce, then continue trend downwards towards like 259, 260 or and then next one is Genting Sing. Okay, Genting Sing, I think is forming a descending triangle over here. So last Friday did a retest of the 88-cent swing low. Seeing a small bounce, but I would expect still quite a strong resistance around 90 cents level over here, which was a breakdown level as well as the downtrend resistance line. So maybe some continued continued consolidation in this small range with a downside bias. Okay, then as for the three local banks, okay, I'll go through DBS first. Okay, DBS is the one showing very strong momentum, breaking out this bullish pennant consolidation, continue from new high. So I think with that, we are likely to see the bullish momentum continue. Yeah, going ahead. And next one is for UOB. UOB also broke above this 28.70 level, currently holding around there. So I think as long as it can hold at this level and break above the $29 level, which was the opening price of this gap down after earnings, we could see price move up further towards 29.20, 29.30 to fill this price gap. And as for OCBC, also recently broke above the 13.25, that level. So we could see price move slightly higher towards a retest of 13.45, the swing high prior to the results. Then maybe some continued consolidation. And I think this is probably like a ascending triangle for now. Okay, then for AEM, still some weakness. Price did a small bounce after the sell down over here. Continue to find resistance around the 5 and 10 moving average. Then there was a breakdown below 227. So I think we could see still some sell down towards a retest of like 210 a swing low recently. Okay, then next one is for Netflix. Okay, Netflix, I think in general a bit of a range bound trading. With some resistance along this trend line. Then also did a retest of the highs around 620 about there. There was a pullback. So I think we could see a little bit more slight pullback towards like 595 over here, these recent lows. Then could just see a bit of a consolidation. Okay, then next one is Silver Lake. Okay, Silver Lake retested another swing low around 22.5 cents. Currently just trading, so I expect that to continue short term. As for Delphi also there was a sell down, then actually feel a price gap over here around 88 cents. Then currently we are seeing a bit of range bound trading. So I expect that to continue for a while for the time being. And Lendlease REIT also some weakness currently. Trading is downtrend channel, and then I think we could see a retest of the prior resistance around 54 and a half cents. Then you could see some slight rebound, but some resistance still around 56 cents for the time being. Okay, Aztec Global has been quite strong, forming over here, forming high highs, high lows, and trading along the 5 and 10-day moving averages. I think for now, could see some a bit of a flattening range consolidation hit for the time being, as it consolidates the gains over here. The Uni Asia has been seeing a sell down towards a retest of the higher resistance around 75 cents. So I think for now, we might see the price hold a bit over here for the time being. But in general, the volume wise for this counter is quite low, so the TA might not be as reliable. Yeah. Okay, then for Samudra Shipping, there's a break above the 74 cents level, did a retest of 78.5 cents, and we're seeing a bit of a pullback. I think for now, we could see a slight consolidation between like towards a retest of 74 cents again, and then some resistance will be around 77 cents, so some slight consolidation for the time being. Then Geo Energy, rebound, then continue from a lower high over here. Then I think you could see a price trend down a little bit towards 34 cents, 34.5 cents to do a retest of recent lows around here. Okay, then for iFast, I think currently it's trending downwards in this channel over here. Also currently under the moving averages. So I think I still see some downside to continue for now. Yeah, still no some bullish signs. Okay, then for Amazon, generally quite range bound, still finding resistance around 179, 180. we could see a slight pullback towards like 172, the retest of lows again. Yeah, they might just continue a bit of the range. Then for Google, currently recently it's looking better. So there's a breakout of this downtrend resistance line over here. And price also broke over 138, this level. So with that, I think we could see if price can form a higher low, probably at least upon the retest, then and a whole move higher, then I think looking quite good for Google. Yeah, for the time being, near-term resistance will be around 144, 145 over there. Okay, then here on Tesla. Okay, Tesla, I think it has reached a support for the time being. Is descending wedge blue color trend line support over here. So I think if price can hold again for 1-2 days, then I think you could see some short-term rebound towards like 171, 174 about there. Then there will be the short-term resistance will be where it is the breakdown level over here. Nvidia, I think for now just some range bound. Yeah, following days, then we had a small bounce. Then currently price is just range bound around 860 to 910 about there. Yeah, so I think that will probably just continue for the time being. Okay, Microsoft form a higher high over here, following a breakout of 415. Then we've seen a back test on Friday. So I think if this retest can hold, then I think it's still quite positive that we can see further higher highs ahead. Okay, the next one is on LHN. Okay, LHN, I think generally wise still quite range bound, still holding at the prior resistance around the 33 cents mark. So I think that would still likely just continue to trade in the range for now. And Marco Polo Marine also just some consolidation around the 0.055 level as well. ESR REIT also continued to trade in the range over here, nothing too much with support around the 29 cents, 29.5 cents. C09 City Developments. Yeah, so I think upon the retest of this price resistance around 590, price just sort of sideways a little bit. So I think for now, we still see some sideways action with support still around 580, the 10-day moving. So yeah, if you can hold these lows, then we might see a rebound towards 6 again. The next one is UOL. Okay, UOL still seeing some weakness. Following a small rebound after the sell down, then still continue to pull back a little bit. Key to see, I think, will be around whether 560 over here can hold. If it does, then we might see a bit of a rebound. But if it cannot hold, then probably we're going to see 550 again to retest the lows over here. What was your take on Palantir? Palantir, we had a sell call because I think short-term wise, I think it's like you see some weakness in the share price. Yeah, with the breakdown of this blue color uptrend channel over here, and then we have false breakout at 2150 as well. Then yeah, so we could see some short-term weakness towards like 2230 over here. Alibaba technical chart. I think for Alibaba, for now, it's still just quite range bound for now. Still seeing resistance at 77 about there. I think we will find support around 71, 72. Yeah, so I think still nothing too much. Yang still can hold 170 already. Yeah, so looking at chart for Yang I think currently is doing some pullback. Did a retest of the 170 prior resistance level here. So then key is to see whether it can hold this level to do some sideways for the time being. Resistance is around 174, 175 for the time being. Yeah, if you cannot hold 170, likely we're going to see price move a bit lower towards 165, the swing move here. Okay, next one is on Yoma strategy. Okay, for Yoma, I think yeah, recently tried to break over 0.04 in this resistance, but then it just hold in the range over here, then subsequently broke down a bit. So I think currently retesting the 0.044 support level again. So we could see a bit of a range bound over here for the time being. Okay, next one is on ARM. Yeah, ARM I think it's likely to see some weakness ahead. So recently broke below this 132 support level, then here retest on Friday, but it's met with the resistance. Also, the current moving averages are trying to slope downwards as well. So in short term wise, we could see a further pullback towards a retest of the lows at around 117 over here. Then we get a bit of a bounce range really. Okay, then for AMD recently have pulled back towards a retest of the range breakout around 183 over there, and seeing a small rebound. So I think short term wise, we could see a bit of slight rebound towards like 197 to about 200 to retest this broken support, which will act as resistance about there. And then short term wise, I think not too much downside because we have this blue color, this key uptrend support line over here as well. Also, this prior strong resistance at 178 to 180 over here. So likely, I think price will find some cushion over here with some range bound. Okay, then for Semco Industries, currently, I think quite range bound. They try to form a lower low with a breakdown of $5 over here, then subsequently recovered the next day. So I think overall, if you can hold like the $5 level, then potentially we could see price move a bit higher towards like 515 about there, or towards like 525 if a higher resistance level. Yeah, so for the price to move higher, I think we still need to break this short-term downtrend resistance line over here. Also the 20-day moving average as well. Okay, next one is on Qualis. Yeah, so for Qualis, I think currently it's just trending downwards over here, quite range bound recently. It was still resistance at 173, but with a higher low over here recently, 162. Let's see whether we can continue from a higher low in this range. Probably just quite range bound still. Okay, the next one is 14. Okay, for 14net, I think some short-term weakness, price broke, did a false break above 71, 30, over here, then seeing price trend downwards. So I think we could see another retest on like the support over at 65, 66 over here again. And then some Hong Kong counters like 81 SMIC. Yeah, so for this counter, I think quite range bound for the time being. Yeah, still seeing resistance around the 1740 and above. Support wise is still coming around 1630, 1640 about it. So I think still some range bound consolidation for now. And next one is on 10 cent. So 10 cent, yeah, recently price move high, broke above this 280 resistance again. And that was a back test to form a higher low over here. So I think as long as this can sustain the lows at 278 over here, then we could see price move a bit high to retest like 296, about 300 over there. 300, we have this key downtrend channel resistance acting on it. The 9888 is by 2. Okay, for Baidu, I think recently did a double bottom over here at 95. Then there was a rebound form a higher low at 99.50. So if this can sustain, probably we could see price move a bit higher to retest the resistance at about 106 to 107. Okay, then JD. Yeah, JD after the break of this 95.50 about there, price is still trending well along the 5-day moving average. So for now, it's still quite strong. I think we could see a retest of 113 this resistance over here if this momentum continues. Okay, next one is the Hong Kong Alibaba. Yeah, I think as mentioned just now, nothing too much for now, just range bound trading. For this, still seeing the strong resistance at 76. Yeah, then the support is around 69 for Alibaba Hong Kong. Okay, next one is Adobe. So yeah, Adobe after the earnings, they had a gap down over here, currently below our prior support level of about close to 500. Then they are sitting above the 490 level over here, which was a prior range resistance. I think for now, it's still quite hard to say how it will trend. I think need more days to see whether how the price will go. But some key support levels is 490, then below that is around 470 to 475. Okay, then for TSMC, I think for time being, Friday it did a retest of this blue uptrend support line as well as the 20-day moving average and the prior swing high resistance at 135. So I think for now we can expect a bit of short-term rebound towards like 140, where there's likely to be some resistance from this horizontal breakdown as well as the 5 and 10-day moving average. Okay, then for Qualcomm, Qualcomm, I think still looking okay generally, the uptrend after the break of 157, a bit of a short-term pullback for now. But I will expect some support to come in around 160, 162, 163 from this swing low as well as this 20-day moving average. Then short-term, some resistance at 170 about there. And this one is Celestica, CLS. Yeah, okay, for this counter, short-term wise, a bit of pullback, but towards the 20-day moving average again, which held as support previously in February, 1 month earlier. So I think if over here you can hold this level, then we could see a bounce in the short term towards like 45.50 about there. This horizontal resistance as well as a 10-day MA. I'll take one more on Parkway Line 3. Okay, Parkway Life, I think currently, yeah, some pullback. I think some let's see whether can form this higher low before a rebound. Recently, since there was a trend of higher lows around here at 326, then 333, 335. So currently here a low of 338. If you can sustain this low, then it will be good for a rebound. But I think if it comes a bit lower, short-term wise, there's still some supports at this 330 level as well to hold the price. So I think for now, looking ahead, probably some short-term range bound ahead with some resistance at 348 about there. Yeah, so I think that's all for me for TA portion today. I'll hand back my time to my colleagues if there anything more to add on. Yeah, thanks.
I think there's no more questions in the Q&A tab. Some of those that I have not answered verbally, I type in the answers. So yeah, so that's all for today. Thank you everyone for your time and spending your Monday afternoon with us. Thank you. Have a good week ahead. We look forward to see you again next week. Thank you. Bye.